Welcome, everybody. We've got August's Verivest webinar, and today we have Mark Jury with Enterprise Bank and Trust here, and we're going to be talking about understanding fund leverage. So, Matt, take it away.
Thank you, Kylie. Yeah, always the last minute behind the scenes technical difficulties before we get started, but I won't bore you with all of that. So glad to be here and camera working and everything. Yeah, today, well, I'm Matt Burke, founder and CEO of Verivest Fund Services. And as you guys know, we do this every month and try to bring people to the audience that would be valuable in their efforts in their fund business in one way, shape, or form. And today we've got an interesting guest that hopefully will fit that bill and provide some value. So appreciate him being here. This is Mark Jury from Enterprise Bank and Trust. Mark, thanks for joining us on the show.
Thank you for having me. I'm excited to be here. I've known Verivest for a long time, and this is fun. So thanks for having me.
Yeah, well, I appreciate you coming in. So Mark brings a unique perspective of on this front. He's been involved on the fund management side, working directly in private lending and so forth before moving into banking. So I think he'll have some interesting observations. But without me telling them too much, Mark, why don't you can you give people a little background on yourself and just kind of maybe start in the beginning? How'd you get in this business? Tell us about what you've done in the past, and then we'll work our way to what you're doing today, and then we'll get deeply into use of leverage and funds. But start with giving us a little background on yourself.
Yeah, happy to. I started my career with Merrill Lynch out in New York, trading and securitizing subprime whole loans. With that, we also had a pretty vibrant warehouse business where we would basically table fund and provide short-term dwell financing for subprime originators. And after the crash, when subprime really struggled, we ended up foreclosing on a lot of those lines. So while securitization itself is also, a debt tool, a leverage tool, seeing debt facilities and warehouse facilities go wrong was probably kind of my first introduction with kind of working through foreclosed warehouse facilities. So I would say that I kind of approach leverage cautiously, which is a bit counterintuitive that I'm at a bank offering leverage facilities, but I think it gives me, the perspective of, how to kind of think about it the right way and how to use it the right way. And as Matt mentioned, I, was at a few different funds. My most recent one was Sortis for 10 years, where we built a private lending fund as well as a real estate fund and a private equity fund. And we were completely unlevered. So that was, a way to go about the strategy. And then I joined the bank in summer of 2023 as I thought there was a lot of opportunity for good private lenders to have lines of credit. And I didn't feel like understanding how lines of credit could interface with private lending was done particularly well. So I wanted to, put my money where my mouth is and throw my hat in the ring and see if we could, provide a little bit better structure for it. So.
Yeah, it's interesting to talk about, kind of the time period back in the, Great Recession when it was really kind of subprime that drove that whole economic period, right? And caused a lot of that implosion. Obviously, everybody's who was around in those days is familiar with that. But having learned kind of front lines the hard way of like what can happen is always very valuable, right? So I'm sure that's informed your thinking around how people use leverage and so forth. So maybe let's start with that. What kind of lessons did you learn back then, and how does that inform your thinking these days of when and why people use leverage and so forth?
Yeah, I'll maybe start by saying very few people predicted what happened in 2008. So it's not as if there was, a crystal ball and everyone could have predicted it. And I know there can be other bubbles and downturns that happen. So, it's hard to, learn directly from that other than what I've seen kind of with leverage is if you become too dependent on it or you're kind of driven too much by terms rather than what works best for your business, that's where kind of leverage can be can kind of cut both ways. I think it works really well when you're using moderate leverage to increase your lending and balance sheet capacity. When you have excess demand of loans that really make sense for the private lending business, but you're just short on capital, I think that makes a lot of sense. If you're doing it to feed a machine or to enter into asset classes and loan products that you are maybe less familiar with and just to kind of grab volume, that's where it can really go sideways because when there's a downturn, those are the asset classes you probably are less familiar with how to work out. And then, leverage is the kind of first priority on the assets. And so it ends up having a domino effect that can really be challenging. So I would say moderate leverage works. Also using it as a cash management tool. Every private lender is doing the dance of, do I have more loan demand this week, this day, this month, or do I have more capital? And the lines of credit can be used to kind of smooth those edges so you're not sitting there with a lot of dry capital when you get a bunch of payoffs or having to turn down good loans when the demand kicks up. So I think those are kind of really the two best use cases, but leverage really should be viewed as a tool in your toolbox, one of many. Raising discretionary capital is another great kind of leg of the stool, as well as selling overflow loans if you have it. So I think it's one of many. You shouldn't become too dependent on any one strategy for your capital.
Yeah, and particularly as it pertains to private lenders, I think, and I know at enterprises, or my understanding, that's your focus, right? There's a variety of types of lines that funds can use, like subscription or pledge lines that you can use to pull the money in before you need it. That's a little different than on the private lending side. But can you just share with people what your perception is of kind of market terms of how you see most of your clients or a lot of people using the lines? Like what level of leverage can they get? What size of lines? How does it get priced? Maybe just walk through the basics of what you see is available out there in today's world.
Yeah, no, it's a good question because there's sometimes confusion around the names of different lines. I think warehouse line gets thrown around a lot incorrectly. A warehouse line refers to table funding and then holding on the line of credit for a short dwell time, 30, maybe 60 days before it either gets sold off or put into a securitization or pledged to a different bank. There's also balance sheet lines, which are kind of meant for balance sheet growth. And then there's what I'll call working capital lines or cash management lines, which are meant to be kind of easier to use, low advance rates, and meant really solely for cash management rather than kind of balance sheet growth, which is really what the balance sheet line is for. So Enterprise offers the working capital and the balance sheet and kind of hybrid in between. We don't get as much into the warehouse lending because warehouse lending is primarily predicated on underwriting the takeouts. And when you're doing traditional mortgage origination and you're underwriting to an agency takeout like Fannie, that's much more reliable than kind of the buyer base um, in the private lending space. So we don't do that. There are a couple groups that do that, but I would say most people focus on the balance sheet growth line. So in terms of terms, I think we're kind of in a tightening period. Like it's gotten a little bit more competitive as of late. So I would say you're typically talking about of advanced rates, and I'll speak mostly on the balance sheet line because that's the most common. 70 to 80% of outstanding balance, sometimes with caps on LTVs or percentages of current value. You're usually pricing with a floating rate, which is sometimes a little bit difficult to understand considering most bridge loans are fixed rate. But we're typically pricing off a 30-day SOFR, which is kind of in the mid threes right now. And so you tack a margin on top of that, call it, 350, something like that. And that gets you a, cost of capital of the line in the kind of low 7% range. Obviously, the bigger the line, the tighter the rates on some of that, and smaller the line, kind of the wider the rates. There's usually an origination fee. I think it's important to dig into who the private or who the line of credit provider is and understand kind of ancillary fees. Are there pledging fees? Are there unpledging fees? There are non-use fees? Are there deposit minimum fees, particularly for banks? So there's a lot of nuance to get into there, but I would say those are kind of the main structures, with balance sheet being kind of most common. And I would say you want to have an established track record, and this might be getting into the next question, so I won't steal the thunder too bad. Well, maybe I'll just pause there then. Matt, I think you're on mute.
Sorry about that. Thank you. Yeah, I'd say, yeah, let's save that. I was going to go there next. So appreciate you hanging tight on that for the moment. But talking about advance rates, you said 70 to 80%. Is that typical, or is that kind of on the high end in terms of like, so if you have, let's say it's a fund of, I'm going to just use a round number, 10 million bucks. I mean, that's 7 or 8 million in leverage and 2 to 3 million. And maybe that's probably too small for you guys. And we'll get to that also in a moment. But is that normal, 70, 80%? Or people are doing that? Because now you're really, if you're charging 11 or 12 to the borrower, right, and you're borrowing at 7, you're obviously making the delta, right, on as much of that total money as possible. And that's one of the few areas, frankly, that private lenders have to kind of significantly move the returns, right? But there's a corresponding level of risk in leveraging it to that point as well, to your point, right? If something really bad happens, then it's harder to manage that. But where do you see most of your clients running in terms of actual leverage rate, not necessarily what the max is in the terms, but how they actually operate the fund?
Yeah, so there's other components beyond advance rate that I think are important to talk about, and we might get into that in a second. But basically, kind of leverage covenants and DSCR covenants that do also impact what groups
Yeah.
actually use. So the way that I would frame it is the 70-80% is fairly typical. It can sometimes be lower for other asset classes like ground up construction or like commercial real estate. But that is pretty typical on a loan by loan basis when you're pledging those loans to the bank. That is a typical advance rate that you can use. Now, most private lenders, most of our clients, aren't basically leveraging up 3 to 1, which is, let's use a 75% advance rate. That's what the math pencils out to be, is 3 to 1. You put in,
Yeah.
one portion equity and then 3 portions debt to get you to the 100%. Most groups aren't doing that across the board. Usually they're pledging a subset of loans that kind of work best for the bank or aren't imminently about to pay off. Most private lenders will originate some loans for their best borrowers or because it was just a screamer of a deal that maybe don't fit well with the bank's parameters, and so they're not pledged. And so where most of our groups are kind of levering, and this is my experience, other banks may have different experiences, but they're generally using about 50% equity and about 50% debt. And we'll talk about the covenants here in a second and kind of how that's monitored, but that means that you're only pledging a subset of your loans at the 70 to 80% advance rate. And then
Yeah.
and then the rest are effectively unlevered.
So are you guys you're using a borrowing base or eligibility requirements and so forth? So maybe walk people through kind of how that works. I know that, I'm familiar with that, but it was a concept that took some getting used to. Um, how does that work?
Yeah, no, I think this is really important. This gets into kind of the mechanics of use, which is where I've seen private lenders that are dissatisfied with their banks. This tends to be the kind of number one friction point, is lack of ease of use. And I think this is where the rubber meets the road about banks not understanding private lenders and how important it is that capital is available very quickly, because deals come up and you need to fund them in, 12 hours, 24 hours, et cetera. And so you need to have that capital available. So what a borrowing base structure refers to. So both of our lines of credit, and for the most part, everything other than warehouse lines are what are considered back leverage. So you're originating loans with your own capital, 100% your own capital, and then you're pledging them to a line of credit and you're getting additional capital out to go originate new loans, fund, investor distributions, fund rehab draws, what have you. So what you're doing is effectively on a periodic basis, most of ours are monthly. You're creating what amounts to a loan tape. You're sending that over. These are the loans that are pledged to the bank. And then here's the corresponding pledging documents, usually an assignment of mortgage and deed of trust, typically an allonge that endorses the note, so that this is functioning as the bank's collateral. They're taking a senior position in those loans, in that pool of loans, and then they're providing these advance rates. And at least in our structure, what happens is that creates availability. So we'll just use some rough numbers. Let's say you send over $10 million of outstanding balance, a portfolio of loans, and we get a 70% advance rate. That creates 7 million of availability. The way our process works is throughout the month, you then have access to up to 7 million bucks. If you originate new loans, you want to pledge new loans, you can always submit a new borrowing base. But in the kind of actual use case of it, that $7 million, you can draw it all day one and then go and use it. You can pay it down as you get payoffs that come in. You don't have to. Let's say a loan on the borrowing base pays off. We're not turbo requiring all of that capital, all those payoff funds to come in. You could use those proceeds, turn around and originate a new loan, pledge it in the next month, and keep your availability that way. So for me in particular, when I moved to the bank side, I wanted it to be very, very quick to access capital. So creating that availability and then having private lenders be able to access, draw that, pay it down, draw that, pay it down as many times a month as they want, as quickly as they want. You can even do it automatically via a loan sweep, which means you don't necessarily have to even request it as long as there's availability. So you can pull it yourself. That I think has really been helpful for private lenders who depend on quick access to reliable capital for deal fundings.
Yeah, I know from experience, both personally and with a lot of clients, that what you described there is the not understanding private lenders. I mean, there are a finite number of people and banks that do what you do that really go deep on that space and understand it extremely well. And then there's every other bank that kind of might do it for a client one off here and there more locally, but really doesn't understand that business. That seems to be the case. How much is out there in and without naming names or identifying all of your competitors, but what do you see as the landscape for lenders doing what you guys do for private lenders out there these days?
Yeah, it's interesting for as I don't know, as appealing as this space is, there's very few banks that I think really understand it and lend well into the space. I would say it's less than five that are really five banks nationally that really understand the space and do it and have a formal program. So, for example, my team only lends right now to private mortgage lenders. We may expand into other non-mortgage asset classes, but all we do is we lend to private lenders, often called lender finance or private lender finance. There's really less than five, I think, that do this day in and day out and are really dedicated to this space and understand it. And it's a small market. We see each other at the conferences. Like
Yeah,
there's plenty of private lenders that need this capital. So I think that there's plenty of opportunity in this space. As you mentioned, Matt, there's a lot of banks that maybe not a lot, but probably another 20 to 25 that I've run into that will do this one off, two off for a group in their
yeah,
backyard that already has a big deposit base with them. But that tends to work because you get really appealing terms, but then you run
yeah,
into hey, wait a second, why are you asking for all these requirements that don't apply to private lending? Well, we had to put it under our C&I umbrella, and this is our C&I requirements. And
yeah,
then you get into that space, which ends up being kind of frustrating for the private lender sometimes.
Yeah, and then I mean, there are sometimes they'll give you terms that are way better just because they're not really sure what they're doing, but it inevitably it turns around and goes the other way when it comes to operations, or they change their mind, or the chief credit officer decides this is not something that they want to do anymore, or the regulator didn't understand, why they're doing this and it
Exactly.
was categorized or whatever. Um, Describe, if you can, Mark, for everybody, is like, what does your ideal client look like? I mean, how big are they? What are your minimum requirements in terms of line sizes? Like, who are you guys targeting? Paint a picture of what the clients look like that you've seen be successful in working with either your bank or others that are kind of in the same space that you're in.
Yeah, absolutely. I'll get a little technical here in a sec when we start talking about covenants because I think these are important kind of metrics and measuring sticks for private lenders to know kind of when bank financing makes sense. But um, our target line of credit size are like 10 to 30 million. We'll go up beyond that, but we typically like to start in that range. Some of the other competitors in the space, like bigger, they'll maybe start at 20, 25, 30, or maybe even 50 minimum size. And some, maybe not some, but one to two, maybe we'll go lower than that. We'll
Yeah.
go below 10 million. It's all the normal things that you would expect. We want to see that you have a history of lending and getting your money back and managing capital. Just because you've brokered a bunch of loans or white labeled a bunch of loans doesn't mean you know how to manage a balance sheet of loans. And so that I think is an important distinction of loans you have on your balance sheet, capital you have on your balance sheet, rather than volumes you do or stuff that you're servicing only, but somebody else owns the loan. So I think that's certainly important. Um, Third party vendors, I think, is one that I could certainly argue both sides of, and I'll use appraisers and appraisals as an example, but you could extend this to fund admins or inspection companies or any number of other groups. But having been a private lender, I can say pretty straight face that sometimes appraisal values come back and they're frustrating and they're inaccurate and they're not using the right comp set. And especially if you lend very locally and you know your micro geography, you probably could come up with a better value than an appraisal company could. However, you can understand the potential conflicts of interest. If you're just coming up with your own value, the bank can't just accept that at face value, right? There's plenty of potential conflicts there. And so the use of kind of third-party vendors is a way to help add some checks and balances in that I think is important for banks. Because we're regulated institutions, right? We're managing individual deposits and we have to be kind of comfortable. So there have to be some checks and balances in place. So I would say track record, how you've dealt with defaults. Have you experienced defaults? What's your current default portfolio? We also understand, and this is something that banks don't always get, but coming from kind of the NPL and subprime world, we understand that defaults aren't necessarily a bad thing, but how you manage them through and whether or not you're taking losses or if you're recovering all of your, late fees and default interest and all of that, those are two very different ball games. So those are kind of all the normal things that you would want, experience in lending, track record, performance, all of that kind of stuff. And you need to be able to show that in some sort of, presentation or something, which usually kind of corresponds to your investor materials. But some of the smaller groups, or if you have just all your own capital or family office capital, maybe you don't have robust investor materials. So kind of putting all that together. The covenants I wanted to talk about really have to do with kind of leverage. And this is one thing that if I can have you take away one thing from this webinar, it's when you're raising capital, raise it as equity, don't raise it as debt. And what I mean by that is if you enter into a fund and you have your investors come in as LPs, you're raising capital as equity. If you're lending them money via promissory notes or debentures or borrower dependent notes, or there's a lot of different ways to do it. And we can lend to those groups, but they're showing up as debt and we're showing up as debt, and that can potentially make the covenant ratios of debt to equity look extremely high, and that can be difficult for a lot of banks to get their arms around. I know most banks that even are familiar with the space will not lend to private lenders that raise capital as debt. So I would say if you're thinking about starting a fund or you're thinking about launching a new fund or pivoting a fund, raise capital as equity, as LPs, rather than as debt with promissory notes. There's just a lot of additional considerations. And the second covenant is DSCR. Everybody knows that from this space about writing rental loans. Banks look at it as well. And if you're having to pay fixed debt payments to investors, your DSCR is really, really low. And that also is concerning for the bank because those are obligated payments versus if you're raising capital as equity, you can pay your senior secured lender your line of credit first, and then they get what's left over, and that comes as a distribution rather than as a debt payment. So I know that's a bit technical. Happy to get more into that. I've written an article recently, actually one just came out today through AAPL that touches on that, but happy to dive more into that. But I would say that those are kind of important considerations.
Yeah, that's good information. And as we get here in the bottom of the hour and wrap up pretty soon, if anybody has any questions, you want to type them into the Q&A box, please do. Happy to try to answer those as we go along. Couple other quick questions then, Mark. So if I do some math, you say 10 to 30 million in deal size, and if you're, let's say, maximum leverage at 70 to 80 but running more like 50, that means somebody's got to be kind of at maybe a minimum of around 20 million in fund equity to sort of get to a point where they're going to be a viable candidate for you, and ideally they'd probably be more like 30, 40, 50 million or up to take advantage of your line. Is that a fair back of the
And
envelope math there?
I think that's pretty close. I would say that we could probably look at groups that are maybe even a tad smaller than that. Again, our total liability to tangible net worth or debt to equity covenant ratio typically hovers in the 1 to 1, 1.5 to 1 range. So if you want a $10 million line of credit from us, the bare minimum you need is $10 million. Usually we're not lending to groups that meet the bare minimum, right? The same way that private lenders aren't looking for groups that barely kind of get over the threshold
Yeah.
of their underwriting guidelines. So I like to tell folks for kind of smallest line, 15 to 20. We do have groups that have several hundred million and utilize a very, low leverage structure, but we also have groups that are in that kind of 15 to 20 range. And so the other thing that I would say is because there's so many structural nuances of what works well for banks and doesn't, even if you're below that size, reach out. Let's have conversations. Let's talk about the direction you're heading. We've had so many conversations with groups that were too small 2, 3 years ago, but they kind of heeded the guidance that we gave them. They've built a fund that works much better to work with a bank. And now we're, in diligence or we're writing term sheets or we're closing loans with them. Because if you wait to 15 to 20 million, but you've structured your fund all incorrectly, it's going to be much, much more challenging to kind of pivot at that point.
Yeah, and I agree on the structuring component. And as people probably know, as a quick plug on the Verivest advisory stuff, one of the things we've done a great deal of and continue to do is a lot of work with managers thinking about setting up their own fund. And Mark's absolutely right. Setting it up properly in the first place, not only for the ability to deal with a bank, but for all kinds of other considerations is important. I've seen, I don't see too many anymore that structure the investor capital as debt. You'll see some that might have a portion of it as debt. You'll see I mean, the reason people choose to do it typically is because it's just simpler, it's easier. The
Right.
investor gets some fixed rate of return. You issue a 1099 instead of a K1, right? But you're trading a certain set of conveniences for an entirely different set of issues, right? And so people just need to be thoughtful about all of that. So, that's a good point. One of the questions we had here, Mark, is can you discuss are audited financials a requirement for a line of credit? Is there any other alternatives if somebody's at a low enough advance rate or they have a significant enough track record, or is it a flat out requirement to have audited financials to do a credit facility?
Yeah, great question. Before I answer that, I'm also going to give a little bit of a plug to Verivest. Any client that we've worked with that use Verivest has been absolutely fantastic. Some of the best structured groups that we've seen. So, getting out ahead of that early on is really helpful. And we do see a lot of groups that still structure as debt. And I think the institutional players like yourself, Matt, and others are advising people to go the LP route. But to your point, it's easier, and so some groups set it up the other way. For audited financials, for most banks, it is a hard and fast requirement. For us in particular, for $10 million lines of credit, we are able to accept non-audited financials, but it has to be CPA reviewed, or potentially, compiled. It can't just be the accountant on staff that works for the private lender. There's got to be the same kind of third party arm's length review, but we can accept that for smaller lines of credit. But as you grow and as you want larger lines, it is going to be a hard and fast requirement. Most funds investors want that anyway, but we are sympathetic to the fact that it is a big cost when you're a small fund. And so we've found ways to get around that for smaller groups, but you should certainly be communicating with your investors that that is the intent as you're growing, and maybe not something you need to do when you're still, pretty small, but something you should certainly look at when you start getting above the 10 million mark.
Yeah, I'd say when we're architecting funds for people, our general default guidance is that you want to get to a point where you do an audit and you want investors to know that you're willing to do it, but it is a significant cost in the early days. And especially if people are starting largely within an ecosystem of people they know pretty well, so you put a threshold in there, say the fund will get audited when it reaches 20 million, 25 million, something like that, right? Because then it can absorb the cost of that audit, and that's also about the time you'll need it for doing relationships like yours. But so there's ways to deal with that in the setup in the first place. So one other question here, I'm not sure I understand it entirely, but it says raising capital as equity. If we're table funding now our investors, so you're table funding, and they're on the note and the deed of trust. I'm not sure I don't know that that applies necessarily to a fund because you're not making loans to individual deals, are you? You guys are doing this more to pooled investment vehicles, not necessarily one-offs.
Yeah, so there's a lot of different names for what was just described. A lot of people call it trust deed investing or fractionalized investing,
Yeah,
basically where somebody else owns the loan effectively, and they're kind of
yeah,
operating as just the originator, but they're not putting capital in. So the challenge with that is because of our covenant structure, we need to face an entity that has a balance sheet that will meet those covenants. And your various investors are not going to be party to our loan agreements, so that structure would those investors wouldn't count, those loans wouldn't count. And I think they admitted it in their question. If they're table funding, that means they're not really balance sheet lenders. And so that structure, wouldn't obviously work with the bank, but even if you are holding loans on balance sheet, if you are assigning individual loans to an investor as a way to collateralize their investment, all of that kind of falls under the category of raising capital as debt. You have to assign a loan to the bank in order for it to create availability on your line. You can't assign it to two places. So
Yeah.
that's why getting investors, if you are looking to grow a fund, getting investors comfortable with the idea that, hey, we would like to get debt. It'll help improve the returns for the investors, but in exchange for that, investors, you have to be unsecured, you have to be equity, and you have to be subordinate to the bank line of credit. I think that expectation management early on is really helpful because once an investor is used to a 12% yield where they're collateralized directly by a particular loan, it's really hard to kind of unseat that and say, hey, why don't you be an LP investor and receive 8.5%? It's a tough conversation, but I think that savvy investors do understand that that's the way to scale, and especially as you build track record, you become a less risky investment, and therefore the return profile can change.
Yeah, the whole conversation around fractionalizing and doing individual trust deeds versus doing a fund. I mean, I've had that conversation hundreds and hundreds of times over the years, and it's it's look, there's no one perfect structure. So they each has their pluses and minuses. Some are right for some people, others are right for others. It's really an individual thing. They have different implications and so forth, but it's always an interesting conversation. So hey, we're running out of time, Mark. I appreciate you being here. Before we sign off, can you just want to tell people, just give them your contact information? How do they reach out to you? What's the best way to get a hold of you if anybody wants to learn more about enterprise?
Yeah, hopefully the people can see what's on the screen, but that's my email address. We make our way to a number of conferences. We're going to one next week and a few others the rest of the year. So always happy to have a conversation, whether it's something you're ready to look at, immediately, or you're planning for years in the future. Always happy to have a conversation. So Matt and Kylie and Sai, thank you so much for having me on. I really appreciate it.
Yeah, thanks for coming on, man. It's an interesting conversation. I know it's a hot topic for a lot of private lenders around, do I use leverage? If so, how much? How do I use it? What are the operational implications? What's available, et cetera, et cetera. So yeah, I encourage anybody to reach out to Mark if you're thinking about doing it. And I know a lot of folks are. So Mark, thanks for being on. I appreciate it.
Absolutely. Thank you
Uh,
for having me.
Thanks everybody for showing up today. Appreciate that. We'll be back next month. Our next guest is a gentleman that we're working with to get that set up on the show, but it's involved in other types of capital advisory, raising money, and particularly using artificial intelligence tools that are rapidly advancing, as everybody knows, to help do that more efficiently, more effectively. So it should be an interesting conversation next month. So thanks everybody for being here. Appreciate it. And we'll see you next month.